Let's get down Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week is our tribute to Life Insurance Awareness Month. And on today's show, the purposes and types of life insurance. And with me today, our consumer reporter, Cassie Rohde. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Cassie.
Thank you.
How you doing? Day 2?
Good.
Hey, a little different than being on camera than it is being on line, being the Google-like generation that the millennials are. You doing all right?
Definitely, yeah.
Well, let's talk about it. What we've done is we've collected all these questions from consumers when they're always asking us, what are the basic ideas? What are the purposes? What can I use this for? How can I solve ideas? What we've done is we've tried to collect the top 10 or so basic considerations so that you can kind of see how this works. So let's just go through the first one, Cassie.
Okay. Well, what is creating an estate?
Well, a lot of people say, I don't really have an estate. I can barely keep my budget, right? But remember, you can create an estate with life insurance. Let's say you and your wife are in their 60s. They want to bless their children when they pass. But they really don't have enough money. They're really living on a tight budget. But they might be able to afford maybe $2,000 or so, maybe $3,000 a year, and that could actually buy sometimes 3 to 4 times the amount. Of course, they're paying that every year, and that can create an estate that'll go tax-free to their children. So sometimes creating an estate out of nothing, life insurance can be one of the great solutions because right now, as an example, a male who would put a $100,000 deposit might get $400,000 in tax-free benefit. A female that would put $100,000 down would get maybe around $500,000, a 5-to-1 ratio. But if they were both on the same contract called survivorship, which we're going to get into later on in the week, they could actually maybe get 5.5 to 6 times or $600,000 for the same $100,000 deposit simply because of the leverage. Now remember, we're using the best health considerations and non-smoking. But think about that's real leverage. You could create an estate using life insurance.
Okay. Well, what about paying death taxes and other estate settlement costs?
Well, yeah, there are only 2 absolutes in life, death and taxes, and Uncle Sam's going to want their piece. Interesting enough, the federal unified credit now for married couples is over $10 million. So unless you got an estate that's over $10 million, you're probably okay. But just a heads up, most of the states in the United States have not shadowed the federal unified credit. So many states are very low in their exemptions. So you may have a bill, maybe you're not going to pay the federal government when you die, but you may very well be obligated to pay estate taxes at the state level. So this is one leveraged way to pay estate taxes and, of course, as it says here, estate settlement costs. And by the way, a little side note, that includes final expenses, your final medical expenses, as well as, funeral costs.
Right. All right. Well, what about funding a business transfer?
Well, everybody's having different. What's happening now is the greatest business transfer of all time is taking place between the baby boom generation and their millennial children. And I bet you'd like to hear about that because you want to inherit a good business, right? But think about it. Funding a transfer. Sometimes the business is really tight for money. Sometimes they have monies that they want to keep to invest in other acquisitions. We can create the ability to transfer one business from one generation to the next in an inside transaction like family, and that transaction can be paid for at the death of the business owner as he passes it on to the next generation. So this is a great way to fund and keep things in the family and leverage the price tag. I just told you what the price tags are. Male, maybe around 4-to-1, female, 5-to-1, and second to die, 2 people on one contract, 6-to-1. So it's huge leverage. And remember, if it's set up correctly, those proceeds can go tax-free to the beneficiaries.
Okay. What about paying off a mortgage?
Well, let's just do this. Most people today, you're either a dink or you're a dirk. What's a dink or a dirk? Dual income raising kids or dual income no kids. Most people are predicated, their budgets are predicated on 2 incomes. How about yours?
Yeah, 2 incomes.
I mean, if something happened, it'd be a problem, right? If one person died, could you make your mortgage payment?
Nope.
It would be tough. So dual income raising kids, adding that to the plate, I not only have bills to pay, I have to also raise kids. So one important thing about this is paying off a home mortgage. So your home mortgage. So if your husband dies, those proceeds could be used not only to pay his last expenses and his funeral costs, but it also could pay off your mortgage. That would take a huge relief off the surviving spouse to have the ability, right, to have that done and over with.
All right, what about protecting your business from the loss of a key employee?
There's rainmakers out there, these execs that you try to recruit and retain and keep in your business. They're very high prized. And remember, headhunters are always coming after them. But what would happen if your key employee that was bringing in the revenue to your company, what would happen to your business if something happened to your key employee? They're rainmakers. They're bringing in the bacon. And there are people that are running your show at your office that are administrative, and those people are golden. You could never operate your business without them. You need to start selecting key people that you know that are really impact players in your business and start to insure them, so if something happens to them, you're not up the creek.
What is replacing a charitable gift?
Well, replacing a charitable gift, interesting. I want to give something to my nonprofit. I give that whole amount of money, but maybe my children aren't so happy that I donated it to the charity. I've heard rumors that my kids are already complaining that I might be doing this. So what I've done is I might still want to give a cash amount to my favorite charity, but I'll use life insurance to replace the amount that I made the contribution to. So I can still go ahead and give it to my nonprofit, but I'll use the life insurance to replace that amount that I gave away so that my kids are never shorted.
Okay. What about paying off loans?
Well, you can do this for business loans especially. People are always looking, banks love this. Oh, you indemnified us, you protected us in case one of the partners who took a loan out. This is a huge issue. Paying off loans are just, in my view, great opportunities to walk into businesses and say, you have loans, you have debt, this is a great way to cover it. When we come back from the break, we're going to talk about the types of life insurance products that you can use for your client for indemnification, for income, or for inheritance. And don't forget, you can request all our show documents that we use as sample examples from Backroom Technician at ashbrokerage.com. And remember, you can sign up for your own 30-day free trial offer for Backroom Technician. Just go out to their site, www.brtnow.com/trial sign up ASPX. We'll be right back after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back. I'm Steve Savant with Cassie Rohde. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, at www.ashbrokerage.com. Just click on the show logo on our homepage. And just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about the types of insurance products that you can use for your clients for indemnification, for income, for inheritance. Think about it. I have so many inbound emails that we answer every day from consumers. And by the way, I'm not trying to brag or anything, but last weekend I might have answered 200 blogs. I mean, talk about not having a life. And the NFL season was on. Well, let's look at this list. This is just a small list. We're just going to touch on some of these things here. And look at the questions. What do you have for me, Cassie?
What is a decreasing term?
Well, now, you have a mortgage. Do you have term insurance with it? Do you know? Do you have to pay for a mortgage? Did they make you do it?
Yes.
Okay, now one of the reasons why they give you this mortgage, you say they have to have life insurance on it, because if we don't put enough down on our down payment, then they require this. What happens is, the premium stays the same, but the death benefit decreases. And a lot of people have to buy term insurance for their mortgage, and it's required, especially if the deposit isn't great enough.
What about the annual renewable term?
Well, annual renewable term, that's been around forever. An annual renewable term is like a step-up price. Every year, it gets a little higher. The death benefit stays the same, a little different than the first one. The death benefit stays level, but what happens is the price tag goes up. We don't really use it that much. It's not that functional anymore, but for really short-term business deals, we really look at annual renewable term because 2 or 3 years, and that's all you need, that's still the cheapest way to play. And some of those contracts that are ART or annual renewable are actually convertible. So we still use them, but it's really not as popular as our next subject.
Right, the long-term level premium term?
Long-term level premium. Think about this. When I came into the business, you either just did ART, annual renewable term, or whole life, and that was the product line. Today, term is built in almost all of them in 5-year increments. So you can buy 5-year level, you can buy 10-year level, 15-year level, 20, 25, 30. We even have a couple carriers out on the marketplace that actually do 40-year level term. Unbelievable. That's how long or extended these contracts have become. So you can have a guaranteed premium with a guaranteed death benefit, and many of these contracts have the ability to convert to permanent if you need them. Some of them have a return of premium riders if you want to get your money back if you didn't die, which would be great, right? So you can have all that. So long term, the term is one of the top products that are sold out in the United States today. And when I use the word term, I like the acronym TERM. Temporary expense reimbursement money. To me, that's how I remember it. If I have a permanent need, I shouldn't be using term. But if I have a temporary need, this is an excellent way to go. And let me tell you, it's so competitive out of the market and it's so cheap that everybody should be able to have this to make sure that their loved ones or their business partners or the charity that they love is always taken care of.
All right. Well, the next one kind of confuses me. What is whole life?
Not only does it confuse you, Cassie, it is the #1 complaint in the United States on all life insurance. Whole life has been the secret sauce. Nobody knows how they break apart this product. They can't unpack it. And so there's a lot of complaints all the time because it's a very expensive policy when you compare it to term. Now remember, it's not fair to compare term with whole life or any other permanent form of life insurance because one's for a temporary and another one's for a permanent obligation. So I try to split them up, but whole life gives you a guaranteed premium with a guaranteed death benefit, with a guaranteed time that it'll endow or stop or mature, and it will give you guaranteed cash values that may be good for some conservative savers that like to use it. There are two kinds, participating whole life and non-participating. Non-participating whole life doesn't give dividends. And I say, if it doesn't give dividends, what's the point in buying this? But if you want to look at participating whole life, it might be the way to go. Remember, there's a lot of argument here, and I'm not going to try to solve that today in today's show. But when you're looking at it, I want you to think about it. Participating whole life gives dividends, but dividends are not the same as they are in investments. A dividend in whole life is the return of unused premium.
All right. What about the single premium whole life?
Well, back in the day, single premium whole life was really the game until they changed the tax law and the insurance regs. Remember, if it's too good to be true, the odds are the service will make a change and we'll have to kind of change our way we do things. Single premium is just a single deposit into life insurance that buys you a death benefit. It could be on a single person, it could be on two people on one contract. But after 6/21/88, 1988, Cassie, I don't even know if you were born on that day. We're still here, barely, right? In 1988, they changed the rules on us and made all these great provisions for single premium life. Now, single premium whole life, we're really subject to many of the new regs under TAMRA. And one of the things we do now, it's called a modified endowment contract. A lot of people are still buying single premium for the death benefit. There's still cash value in it, so you could use it if you needed to get to it. It's popular today in older clientele who are looking to get a little bit of return, but still have the death benefit coverage for their beneficiaries.
All right. And then universal life.
Well, here's the debate. Back in the days of the 1980s, when I first came into this business, they invented a thing called current assumption universal life. That current assumption universal life has so many different chassis now and has so many different ideas. And when we talk tomorrow, we're going to break some of those ideas out because there are really that many inventory issues to talk about. Well, that's our show for today. I want to remind you that you can read all my online insurance news commentaries, advisor blogs, and articles on Producers Web. And read all my answers to consumer questions on insurance products on Insurance Library, as well as you can see all our shows on our on-demand section located at Ash Brokerage. Don't forget, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor.